right. Greed works.
Hello and welcome everyone to another episode of Let's Play Wall Street Raider. This is RakeM, your host. Before I start today, I want to mention something that I noticed last time. If your screen appears to be a little bit blurry, please go to your YouTube settings and watch this video in 720p or the 1080p resolution. That will ensure that all of the video will be clear. You'll be able to read all the messages on the screen. So if you had any trouble last time watching the video and you want to have a clearer and crisper image, just make sure that you're watching the video in one of those two resolutions. Alright, with that out of the way, let's talk about where we are. Last episode we started with $1 billion and we ran it up to $3.8 billion. We took advantage of one of the cheat scenarios that is attached to the software industry. We had our global traffic control system had a bug. We went ahead and released it anyway, made a huge profit. And in the beginning of the game, the cheat scenarios are very, very helpful. You just have to basically hit and run, because those scenarios have an upside, but they also have a downside. So if you execute one of those scenarios and then you don't get rid of it, it's possible that you could face ruin. Episode, our goal is to take our 3.8 million and we're going to try to run it up to hopefully around 10 billion in this episode. Also, last episode, the Fed increased or instituted a tight money policy. If they continue to adhere to a tight money policy, we will be taking advantage of interest rate swaps. The profit potential on interest rate swaps is just phenomenal. We can take about $1 billion of our own money and potentially turn it into 16 trillion or more if conditions are favorable. So I hope to show you that this episode. If not, we will get it. We will get to it when the conditions are right for it. But in any case, at this point, we have our 3.8 billion and we need to find a place to invest it. So without any further ado, let's start taking a look at what's available for us to invest in. Okay, so just like last time, we're going to go to the general menu. We're going to take a look at the industrial growth rates. And I'm going to look for a industry that has double-digit current demand and double-digit long-term demand and a projected return on capital assets of 20% or more. And the first one that comes up there, the biotechnology. Now, the return is a little low, but these two numbers are huge. It's going to have long-term sustained growth. So we're going to want to take a look at that. We may not invest in it now, but we may invest in it next year. We just got to take a look and see. No on heavy machinery, no on integrated oil. And the reason why I say no on integrated oil, you see the difference between the short-term and long-term growth? That means that this industry is enjoying a short-term growth spurt, and that the bottom could drop out of it at any moment and go back down to 5%. So we're going to stay away from that one for right now. It's like down here at the bottom, look at this. This one is precious metals and mining. 29% per year, but the long term is only 2%. And it's got a good return right now, but if it drops down to 2%, that return is going to diminish, very quickly as soon as the bottom drops out of that. So we want double digits at this point in both columns. Network and telecom, again, the percentage over here is low, so we may want to invest in it later. Pollution control, same thing. Software is, the numbers are all high, but we know that that one's deteriorating. That's the industry we just left. There's not really a clear winner in terms of these numbers. So let's just start taking a look at biotechnology and see what it looks like. So, wow, a lot of them are negative, despite the demand growing at 16%. And you can see why. Look at the credit ratings on these companies. They have tons of debt that they're servicing, and the interest rates are going up, so that debt is becoming more expensive to manage. So we may be able to make a tidy little profit in this industry if we just spend about half of our $3.8 billion on buying the companies and the other half on getting them out of debt. Because without the debt, they can grow at that 16% rate. And then the stock price should jump. So let's look and see. We don't know how big these companies are without opening one. Let's look at, let's see, what's a good one to start with? Not Cyocorp, that's owned by somebody else. Let's look at whatever this one is. Regeneron. So Regeneron, oh wow, they're 3% of the industry, and they are only 600 million to buy. You may be able to buy a few companies. Let's take a look back at the projection. Centocor at 6% of the industry, and he only cost 900. So we might be able to get a significant market share if we buy, say, Centocor and one other. So let's take a look. Centocor's here at 6%, and this company Immunex is also 6%. So let's take a look at their balance sheet. And they're highly leveraged, so 1,100, and they owe $2,000. And Centocor was $1 billion, and they owe 1,600. So let's see. $1,100, so $2,000 to spend on these two companies, and then we would have $1,800. Call it $1,600 after the premiums to put toward their debt. All right, so let's see what their management looks like. They're projected to lose money next quarter, most likely because of their debt situation. Centocor is reasonably competent. Immunex is very incompetent. Okay, well, let's not get Immunex then. Let's see, is there another one that we can use? Immunex is here. That one's owned by someone else. HGSI maybe? HGSI is mediocre. But they have less debt than Immunex. And they're cheaper to buy overall. What's their percentage? 4.5%? So that would give us like an 11% market share if we bought them both. Where's Centocor? Here it is, 6.4%. And HGSI. So, let's see, what's their management again? Mediocre. Well, when we combine the two, the result might be reasonably competent, but the main thing is that we can afford to buy them both. So I think that's what we're going to do. Let's see if anybody else owns the stock. No, that's public. HGSI. Global High Tech owns 6%. But this is the one that's only 700 and change, right? Yeah, okay. All right, well, let's go ahead and buy both of these two companies. We'll make Centocor the parent, since it's the larger of the two. So let's buy this one, 100%. Yes, we want to buy it, even though it's falling for 5 consecutive months. And, okay, we're familiar with that. 100%. Okay. And now what I'm going to do is I'm going to transfer my remaining cash to CenterCore and have it buy HGSI. So we will do a financial contribution of cash, and we're going to contribute $2,700. So there it is. And now we want CenterCore to buy HGSI. And we're going to buy the public shares first. Oops. Okay, buy HGSI. No. Okay. Okay. And we've taken control. So now we buy HGSI, the privately owned stock. And now the returns on HGSI are low, so hopefully we won't have to pay as high a premium. I'm going to start my offer at 22% and hope that they'll take that. It's kind of low. It's not often that you'll get them to accept an offer that low, but this company, got to keep in mind the credit rating is super low, so they might just take it in order to get some of their money back. So they're thinking about it, and they accepted. All right, so we own both of these companies. Now we're gonna liquidate HGSI into CenterCore, and it can be tax-free because it's 100% owned subsidiary. If it's not, then you have to do a taxable liquidation. And yes, I'm going to liquidate it, and that's been completed. So now the two balance sheets have been combined. Okay, the company has $1,800 cash that I'm immediately going to apply toward either the bank loan entirely, or maybe I'll buy some of the stock, some of the bonds back, because those bonds are 11.75% annually to maintain, and we're paying 10.25% on our bank loan. So obviously the bonds are the more expensive between the two. Now I know that this stock price is not ideal for doing a buyback. Generally you want to buy back bonds when they're below their initial $100 trading price. But in this case, we're going to pay $11.75 million to keep these bonds, or I can pay $4.98 million to buy them back. And so it's the cheaper way to go is to just buy them back. So we're going to go to do that. You go to the financing menu, buy back or call bonds, and we say yes, we do want to buy back the bonds on the open market, all 300 of them, and now that's done. And you can see it's been deducted. It's off our balance sheet. So now we're going to repay our loan for the full amount that we have in cash. And now our credit rating should have gone up, which it has. We now have an A credit rating. Okay, now let's see what we need to make our settings for R&D, growth, and all that. So here's our company. The P next to it means we control it. The growth rate is 16%. Our return is 18%. We're spending 6% on R&D and marketing. So we're still reasonably competent, so that's good. But we're already losing money, so I'm leery about raising our R&D right at this point. I think what we want to do is just reduce our growth rate and pay down our debt a little bit more. And the supply-demand situation should be enough to increase our profit because all of these companies are growing at a negative rate. And so the industry is slimming down, and that will drive up the returns on those that on all the assets that remain. So let's go to management menu, change our growth rate to 6. We're going to leave our R&D the same, and we're going to eliminate dividends. Oh, okay, there were none, so that's good. All right. Now it's got a earnings report coming up in just a few days, so there's no need to fast forward. I'll just turn the ticker on. And as you can see, the interest rate here. I think I forgot to show you this. All of these commodities and the interest rates and everything. You can see the graph of their history. Okay, and as you can see, it's trending upward right now because the Fed is tightening interest rates, which it tells you right there that they're tightening rates. Okay, so let's get to this earnings report. All right, we lost money, but we lost less money than we lost last quarter. We're still losing more money than we made. We made money last year, so we're still trending downward, so we need to turn that around. And we had to borrow money at the end of the quarter to pay our taxes. And once again, here's all the history of everything we just did. So let's take a look at our funds. And if we pay that extra cash down, which we're going to, I think our debt has actually gone up by about $40 million, which is not a big deal. We just don't want it to get into like the 1,500 or not. We want to pay it down, not incur more debt. And here we go. By not growing as much and by enlarging or paying off our debt, our projected income is going to be 77 cents a share next quarter. So that's good. And we're still reasonably competent. And everything looks all right. We have a market share of 10.5%. And based on our growth rate, next year it'll be 10.8. So we're growing a little bit faster than the rest of the companies are averaging. Of course, that's not surprising considering the fact that so many of them are downsizing due to their debt and the interest rates going up. So I think we're going to leave it right there for another quarter. Use the income from next quarter to pay our debt down, and then we'll have a more. Then we'll reevaluate to find out if we can grow some more than just 6%. So, two things to keep an eye on. First of all, let's see what my total investment on this was. $38.15. We gotta figure out what stock price we want to sell this for, so that as we continue to play the game, we have an exit strategy in mind. So $38.15, and we'd like to make 4 times our money, and then we have to multiply that by the 18%. So that's the stock price we'd like to sell it for. We'd probably settle for $150 or even $130 if the market conditions turn bad on us. But this industry has projected long-term growth, so that shouldn't happen. Shouldn't happen, but, could. But 180 is going to be our target. So we're going to keep an eye on that. And then the other thing is, with the interest rates at 9.25% and still going up, we'll want to keep a close eye on that, because if the interest rates get up to 12% or even 11.75%, we're going to probably engage in some interest rate swaps. Now there's some, well, rather than go into that now, if and when it happens, we'll go into it then. So I'm going to turn the ticker on, and we'll come back when either the next earning report comes out or when this interest rate gets above 12. So CenterCore had a huge quarter, earning $1.52 per share. Last year they lost money. This year they're growing, or they're earning like gangbusters. And we had tax credits of $36 million, so that boosted our earnings as well. We have $46 million on hand, repaid $4 million to the bank, and have a bank loan balance of $12.91. Okay, so all that's good, but let's take a look at the projections for next quarter. $1.84, so it's going up from our $1.52. We're still reasonably competent. So at 6% growth, we had a surplus of $4 million. So we really can't grow more than the 6% without going into debt. Is that what it said? 4 million was the surplus? Oh, 46 million, and we repaid 4. Okay, so maybe we can go to, say, 7%, but that's it without going into debt. Now with the interest rate coming down now, that might be affordable. It might be affordable to go into debt to make 28% on additional assets. And the growth rate has gone up to 19 from 16. So, yeah, I think that's a safe bet. I don't think we need to go too much higher. Let's say we will go to 10% for right now. And if we incur a little debt, that's all right, because we still have an A credit rating, and we can go a little bit further before we would drop down into the triple B rating. Okay, so stock price, we're up to 88 cents a share. Our goal, we're halfway to our goal almost. And I think that's all we really have to do right now. We could almost, well, we got 2.5 times our money in the stock at the moment. Oh, it's already up to 105 on the strength of that earnings report. Okay, well, let's keep an eye on that. And I'm going to go ahead and remove Real Networks and these other stocks from this shortcut list, because we don't need to be bothered with those anymore. Alright, so we're going to go ahead and fast forward to April 10th, unless there's any other event that we need to talk about. So back in just a couple minutes. So this quarter we made $2.18 a share for a total of $218 million, which is a huge increase. And we didn't have to borrow any money, so that's great as a result of that increase. So we can repay our debt down another $148 million, or we could increase our growth rate. So DNA, you notice, has jumped its growth rate up to 29%, which is enough to service 40% of the industry. Okay, so let's take a look. It's still improving overall, the supply-demand situation. So we can still increase our growth without hurting our growth in pre-tax returns on assets. We're still reasonably competent, so we don't have to increase our R&D spending. Our percentage rate of return has climbed all the way up to 30%, so that's good. And I think what we'll do is we'll leave our debt the way it is, and we will increase this growth rate by another 2%. Make it 3%. So let's change this to 13%. Okay. And we already paid down, let's pay our debt by $148 million. That takes our total debt down to $1139. And our stock price is already at 161, so we may turn this one around. We may flip it a lot faster than I thought we would. I thought it would take more like a year, but that industry demand, supply-demand situation is really helping us out here. What's our projection for the next quarter? 224 again. Isn't that exactly what we made? Oh, 218 is what we made. So it's going to go up a little bit more. Still improving after we increased our growth rate. This, by the way, this calculation is immediate. It's the projection that's not immediate. That one takes a month to get updated, or it updates at the end of the month, I believe, every month. Okay, so we're going to run the simulation now to July 10th, unless, again, this interest rate climbs, but it's not supposed to because they changed to an easing policy. So we're going to let this run to July 10th, and I'll come back when the next event happens. So for this quarter, we made 237. The projection was 228, so we beat the projection, which I don't know if I said before, but anytime that you beat the projection, you get a little extra bump in stock price. We made $236 million, We have $51 million in cash. We did not have to borrow, so our 10% growth rate is fine because we had a $51 million surplus, which we can apply toward our credit. Our debt. And okay, we have a memo. Let's see. Okay, this is another cheat scenario. The corporation is presented with a unique opportunity to increase earnings and cash flow with a minimum investment required on our part. A certain Middle Eastern leader, the maximum leader of deleted for security reasons, I wonder if you can guess who that is, has put out feelers secretly to us through our Geneva office, blah, blah, blah. What's the bottom line? They will immediately transfer $700 million to our account with such and such bank in Vienna. If we will do what? What are we being asked to do? They got wind of our research conducted for a highly contagious, incurable, untreatable pathogen that kills all humans who come in contact with it within 12 hours. Oh, so we need to enable them to poison people with biological weapons. Well, that's an ethical dilemma. I know how to deal with that. It worked out well for us last time. What do you think, Gordon?
Greed is right. Greed works.
Absolutely, we accept. Let's take the $700 million, and that will probably get us to our goal of $180 per share. Okay, and here's the projection. This is before that cheat scenario took place. So this 244 was what it would be if we did nothing. And if you remember, we had $236 million in profit, not profit, but earnings last year or last quarter. If you add $700 million to that, we're looking at what would that be? 9.44 instead of 7 or 2.44. So that should make a huge difference in our stock price. So once again, we are going to wait till the end of the month, because right now it's July 10th. So on July 31st, our projection should get updated, and this stock should just explode. So I'm going to turn the ticker back on, and we'll just keep an eye on this. At the end of the month, it should jump. Ninth, 30th, 31st. All right. So it's been updated. It didn't turn into the number I thought it would, but it's still significantly higher. And we already have the $700 million. So we could go ahead and pay down our debt, but we don't really need to, because the interest rate's lower, and we're making a significant profit at this point. So rather than pay down our debt, we could go ahead and put it toward growth. But, oh, look at this. It has dropped to 8%. And it's probably mostly due to this guy overexpanding. So yeah, I think it would be better actually to spend it on our debt than to further saturate the market here. But we're not really going to hang on to the stock as soon as it hits 180 or starts to show signs of slowing down in terms of climbing. We're going to we're going to sell it. But let's go ahead and pay the debt down as much as we can so that we get as high a price for our stock as we can. So basically, when this gets to be 180, we're going to pause the simulation and then evaluate what we want to do. Okay, so we've hit 180. Now let's evaluate our situation. They still are expanding at a huge rate. The growth has gone up to 12, so that's good. But I think it's time to go ahead and sell it now. Let's see, is it deteriorating? Yeah, it's deteriorating. And our management is still reasonably confident. They've revised our projection to go up to 7.79. So I don't know. We could maybe hang on to it for a little bit longer. Right now it's September 20th, and the earnings deal is due on the 10th of next month. Now, as soon as that earnings report hits, I don't expect our stock to continue to go up after that point, because this is a one-time hit, or one-time boost that we got, and our earnings per quarter is going to go back down into the $2 range at the most after that quarter, so the stock price will come down accordingly. So I think what we'll do is we'll run the simulation, and if we get back up above 180, we're going to go ahead and sell it. It'd be nice if we got it in like the 185 range, but I don't want to be greedy, because in this cheat scenario there's also a downside. If the sale of those biological weapons is detected by the government, we'll be levied with huge fines. So hanging on to this is risky. So let me turn the simulation back on and hope that this gets back above 180, and if it does, then we'll sell it. And there it is, 183. So we're going to go ahead and sell that stock and take our profit. And this time we're going to have to pay, it's the same percentage, but it's 2.2 billion, 2.3 billion. So we got a gain of 309%. And it's now controlled by no one. So our turn ended, so the stock ticker has paused automatically. So we've got 15 billion now. And let's see, 21.23 of that in taxes will be due. So that 22.77 that they estimated was a little high. So if we deduct the 21.23 out of here, we're going to have 13.5 billion. That's what we run it up to. We made about 4 times our money, or a little over 3 times our money, after taxes. So that's pretty good. Now the interest rate's way down. If this keeps going down, which it's not supposed to, because they're tightening, but if it happens to dip below 4%, we're going to do those interest rates. But we've been going for almost an hour now, so I'm going to call this apart, and we'll pick it up next time. One last thing I want to show you before we end, though, is the My News. If you remember, I told you about the earnings report down here. Anything that you do with your company, it shows up here. Well, you can use My News to show the news on all of your companies. So anything that you own or control, or maybe it's just control, but any of the news for all those companies will show up here. And as you can see here, after I sold it, Petro Brasilia bought it. So when we sold it directly to them. But in any case, I wanted to show you that. I forgot to show it to you in the first episode. Alright, so until next time, guys, this is RakeM saying have a good one.